Hi guys, welcome to Stock Brains. My name is Ayush and today in this video we will talk about moving averages. So moving averages is one of the most effective method to identify trend and it is one of the most favorite subject of mine, so I enjoy talking about moving averages. So we will discuss what moving averages are, and in my opinion it is one of the best ways to identify trend in the financial market. So in this video we will discuss what are moving averages, we will discuss types of moving averages, different kind of moving averages like simple moving average, exponential, linear weighted, and so on. We will discuss the different kind of strategies which you can make in moving average and trade in the markets. Then we will discuss what are envelopes, bands, and channel. So these all things we are going to discuss, and apart from that we will discuss some important indicators which you should know when you use moving averages, and we will discuss when to use moving average, when not to use moving average. So this video is going to be a complete guide for moving average. So before starting the video I would like to tell you one thing. So if you come to our Stock Brains channel, and if you come over there, then you will find that we have made CMT level 1 chapter wise videos, and our team has tried our best to make this video in English as well as Hindi language. So if you are someone who wants to prepare for CMT level 1 exam, then I think these videos are going to help you. Apart from moving averages, I have covered a lot of topics which can come in your CMT exam, so I believe that you should watch these videos because these all videos are chapter wise, so you will not miss out anything and you will get overall guidance to clear your CMT exam if you watch these videos. So I highly recommend you to watch this video and subscribe to our channel to watch more videos related to CMT. Now let's understand what is the average. Before going to moving average, we are going to understand what is the average. So as we all know that average is simply a number which represents a set of data, and it is also known as mean. So let's discuss the example of mean. So in this question you can see that there is a temperature of 7 days of Chicago. So in Chicago, they have given us 7-day temperature, and we will have to figure out what is the average temperature in the 7 day in Chicago. So to calculate this, the formula is very simple. You put out all the days information over there. You sum up all of that and you divide that by total number of days, which is 7 in this case. And after you do the calculation, you figure out that the mean is 33. So the average temperature of Chicago was 33 degree. So this is simple mean. As we all know, we have studied this thing in our schools. But what is a moving average? Moving average is nothing but an average which moves. And how does it move? We will discuss that. So moving averages are the constant period averages of past data that is calculated for each successive chart period interval. So this is a definition which can come in your CMT exam. So we will discuss moving averages in a very practical way, and let's go to trading view and understand this thing. So now I have come up in trading view, and as you can see that I have opened up Nifty 50 chart, and this is 1-day chart. And on the chart you can see that there are two lines. This line is red line, and this line is blue line, right? So this red line is 50 days moving average. You can see that in my settings you can see that this 50 line is red line and this 200 days line is blue line. So I think this thing is visible to you. So when I say this is 50 days moving average, I mean to say that the previous 50 days data average line is this. So this red line is representing what has happened in the past 50 days. So that is what moving average is. But when I say moving, I mean to say that this average moves, and whenever any new day comes you will see that this line will move. So I think today the date is 10 December 2021, and after that when the market will open at 13 December 2021, the market will move up, will make up another candle, and this line will move. And as the market would go on, this moving average is going to get moved, right? So this line moves as the market makes new candles and new data bars, and that's why we say that this is a moving average. I hope this simple explanation is clear to you. Now let's talk about why should we use moving averages. So we should be using moving average because they are very much useful in trending market. In other words, if I say that moving averages are useful in a market that have a tendency to trend, so basically if the market is trending up or trending down, then I think moving averages is a very good tool. But the limitation which moving averages have is that moving averages can't work in sideways market. We will discuss that later on in this video. And it is one of the oldest method which are used by technical analysts over the years, and it is a lagging indicator. So what do I mean by lagging indicator? Let's discuss that. So to understand lagging indicator, let's go to trading view and understand this. So as you can see that we have this red line and blue line. Red line is representing us 50 days of data, 50 days average, right? So this 50 days average line is telling us that the trend is up. You can see that the market has gone up. So we can clearly see that okay, the trend is up. But this moving average line is not able to tell us that what will be the trend in, let's say, 1 month, or what will be the trend after 1 year or 2 years. So this moving average line is not able to predict the future. It is just telling us what has happened in the past, right? So moving average is an indicator which tells you about the past, but it does not have future predictability, and basically it can't tell you what may happen in the future, and that's why we say that it is a lagging indicator. And moving average is one of the best lagging indicators. Actually, we have two kind of indicators. One is lagging indicator, and moving average is one of the best example of lagging indicator. And if I talk about leading indicators, then MACD, RSI, stochastic, these three famous indicators are leading indicators because they try to tell what may happen in the future. That's why we say that they are leading indicator, but moving average is a lagging indicator because it does not have much predictability, much future predictability. That's why we say it's a lagging indicator. I hope this thing is clear to you, and this thing can come in your exam, so be ready for that. Now let's move on to moving average characteristics. We will talk about basic features which a moving average has. So technical analysts use moving averages to smooth erratic data, making it easier to look the entire trend. So if you are new to this technical analysis, then you may not be able to read the price action very well. So in this example, you can see that if I hide this moving average, then if you are a beginner, then you may not be able to figure out what the trend is. So some people may get difficulty in analyzing the trend, but if I use this moving average, then you can see that clearly moving average is showing you that the prices have gone up and it is clearly an uptrend. And if I hide this price and if I remove this drawing, then you can see that these moving average lines are telling us that the trend is up. So moving average can help you remove the erratic data, and it can help you determine the trend direction very easily. That's why we use moving averages. And moving average by its number represent a net of past certain numbers. So as in our example, you can see that red line was representing 50 days of data and blue line was representing 200 days of data. So we can change this time duration, and if we change this time duration of the line, then this line will show you a different picture. I hope this thing is clear to you. Now, mostly all the moving averages are calculated on the closing price, because in technical analysis we consider closing price the most important price. Closing price is considered as the most important price, and this thing can also come in your CNT exam. That is why we calculate moving averages on the basis of closing price. But if you want, then you can calculate moving averages upon high, low and open prices as well. Some people do that as well, but mostly people prefer calculating moving averages on the closing price because they feel that closing price is the most important price. And I think one should use the moving averages on the closing price only. Now, rising moving average will show you uptrend, as you know that, and if the moving average is going down, if the moving average trend is down, then it will tell you definitely that the trend is down. And it is an indicator which is based purely on price action. It has nothing else. It has purely price action. It does not have volume or open interest or anything like that. So price action traders can use moving averages in their trading. Now let's talk about different type of moving averages which are there in market. So generally there are three kind of moving averages which are there. The first one is simple moving average, the second one is exponential moving average, and the third one is weighted moving average or linear weighted moving average. So these three moving averages are the major ones which are, so these three moving averages which I have listed above are the most important moving averages which we will discuss. But apart from these three types, there are other types as well which people do not use, but we will discuss that as well. We are not going to go deeper into that. We will discuss these three types in a very deep manner. But Other types we will just briefly cover all of that. Now let's talk about simple moving averages. So simple moving averages are the most commonly used type of moving averages, and the calculation of simple moving average is very simple. So if I were to calculate 50 days moving average, then the formula is going to be very simple. I'll take 50 days of data. So let's say if I want to calculate moving average from this vertical line. So if I want to calculate the moving average from this vertical line, then I'll take all of the data, all of the closing data of these candles, and I'll divide that by 50, and I'll get my simple moving average. So this red line is simple moving average, which is used very widely. So simple moving averages are used very widely because they are simple in calculation. They just take all the closing data, give every data equal weightage, and divide by number of total periods, so you get this final value. So this is simple moving average, which I think is very clear to you. And if I talk about moving average time period, then moving average can be calculated for various length of time. A longer period can include more data observation and thus more information. So if the moving average is having more data observations, then it will move very slowly. But if the moving average is having more data, then it means that it is unlikely to give you a false signal. So let me tell you this thing very well. So let me remove this vertical line. So in the paragraph, it was written that the slower moving average, the slower one, which in this case is blue line, which is 200 days moving average, is having more data points. So it will be very slow to tell you about the trend, right? And the red line, which is a 50 days moving average, will react faster than the 200 days moving average because it is faster, it has more data, so it will react much more quickly than this blue line, which is 200 days moving average. So this red line is going to give you more signals, and this blue line is going to give you less signals. You can see that the price is not even touching this blue line, which is 200 days moving average. So 200 days moving average is not able to generate any signal. But if I talk about this red line, then prices are very near to this red line, and you can generate a lot more signals if you use shorter period moving averages. So the longer term moving average will have less signals, but whatever signals we will get on this 200 days moving average, that signal is going to be very strong, and it is very unlikely to be a false signal. But the signal which we are going to get on this red line can be a false signal. So it is always a trade-off between getting more signals and getting good and reliable signals. So as I said, long-term moving averages will be slower to pick up trend changes, but they are unlikely to give you a false signal. Whereas shorter term moving averages are going to give you more signals, but it's very likely that they will give you false signals. So we must have a combination of long-term moving averages and short-term moving averages to do trading, in my opinion. Now let's talk about using multiple moving averages. So when the shorter moving average crosses above the longer, it is often considered as a mechanical buy signal. If I go to trading view, then you can see that this red line 50 days moving average is a shorter term moving average, and blue line 200 days moving average is a longer term moving average, right? So uh, we are talking about this moving average crossover. So in the slide, it was written that if this shorter term moving average, which is in this case is red line, if this moving average crosses the longer term moving average from below to above, then it is considered as a buying signal. So you can see that here the buy signal has been generated, and whenever the 50 days moving average crosses 200 days moving average from below to above, we say that it is a golden crossover. So here you can see that a golden crossover has occurred. So this thing can come in your exam, so please remember that. And whenever a 50 days moving average crosses the 200 days moving average from above to below, then we say that it is a death crossover. Why we say it is a death crossover? Because whenever this thing happens, we consider that the market is going to go down. So I think this thing is clear to you. The first vertical line is an example of death crossover, and this second vertical line is an example of golden crossover. And you can see that the market has performed beautifully after giving this golden crossover. So I hope this thing is clear to you, and that's how you can use multiple moving averages to generate signal. whenever these moving averages cross each other, they generate signals and we can trade based upon that. Now let's talk about linear weighted moving average, which is also known as weighted moving average. So the calculation of linear weighted moving average is very different from SMA, and it reacts to current price quicker than SMA. Why? Because the more weightage has been given to the most recent data. So as we know that the today information, the today price data is more important than the price data of 50 days ago. So we emphasize that the recent data is more important, and people generally neglect what has happened in the history, and people remember the current events which have happened very recently, and that's why we say that we should give more weightage to the data which has happened just currently or very recently. So linear weighted moving average has been made because of that mindset. In this example, I have calculated simple moving average as well as linear weighted moving average. And in this example, I am going to calculate 4 days moving average. So if I want to calculate this moving average of stock X, which is having a price history of 4353, and these data are closing data, right? So if I were to calculate simple moving average, then I'll simply put all the data and I'll add that and I'll divide that by 4 and I'll get this 3.75 value. But when I am going to calculate this linear weighted moving average, I'll do the calculation in this way. So the four data point, which is day one data point, has been given the least weightage, and this last data point, which is 3, has been given the highest weighted 0.4. Why? Because it is the most recent data. That's why we say that linear weighted moving average gives more weightage to the most recent data, and as the data gets older, the weightage will be lesser and the value will be different from simple moving average because of the weightage that has been given to the recent data, and that's how they can differ in calculation. So let me show you weighted moving average example in my trading view. So as you can look at this chart, this red line is our simple moving average and this green line is our weighted moving average. So you can see that this weighted moving average is able to give me signal much faster than simple moving average. Why? Because the weightage to most recent data is higher. That's why the simple moving average is lagging more than the weightage moving average. So this is one example, and where you can see that how this is performing well sometimes, and sometimes giving long signal. So you can use weighted moving average as well if you want quicker signals. But there are some problems with SMA as well as linear weighted moving average. So in a simple moving average, what happens is that simple moving average gives more weightage to the past data and less weightage to the recent data. However, in theory, it gives equal weightage to all the data, but our psychology says that we give more weightage to the most recent data, and that's why some people believe that the most recent data will be given higher weightage as compared to the past data. But in SMA we give equal weightage to all the data, and that's why we say that okay, it is kind of irrelevant because it is not giving enough weightage to the recent data. But in linear weighted moving average, we say that it disregards early data by giving it less weightage, and it kind of deletes the early data, and that's why it generates false signals sometimes. So there is one problem with LWMA, which is linear weighted moving average, and there is one problem with SMA. So in SMA, the problem is that it gives you signal very late, and it gives less weightage to the most recent data. And with linear weighted moving average, the problem is that it deletes the early data and gives a lot more higher weightage to the most recent data. So these are some of the problems which people faced, and that's why EMA is evolved. EMA stands for exponential moving average. So exponential moving average reduces the lag by applying more weightage to the recent data. However, it tries to give good weightage to the past data as well. So EMA is kind of in between simple moving average and linear weighted moving average. So let's understand that how this exponential moving average is calculated. For example, if I want to calculate 10 period exponential moving average, in this example I am calculating this moving average day wise. So this 10 period is going to be 10 days EMA. So if I want to calculate 10 days EMA, then this is going to be a formula. The weightage which I am going to give to the most recent data will be determined by this formula. So the weightage which I am going to give to the most recent value will be this 18.18% if I were to calculate 10 days moving average, and the weightage for normal days would be 81.81%. So that's how I'll give weightage to day 10, and from day 1 to day 9, that's how I'll give weightage. So I hope this exponential moving average is clear to you. So in this slide you can see that if I were to calculate this exponential moving average on Excel, you will see that that's how I'll calculate it. So I have calculated 10-day simple moving average as well as 10-day exponential moving average. So initially the value is same, but over the period of time this value has changed because we have got more data points. So some difference between exponential and simple moving average is going to be there if you use them in conjunction. So now let's look at charts. How does this 50 period EMA and SMA works? So you can see that the 50 period EMA is faster than 50 period SMA. This 50 period SMA is lagging more and EMA is lagging less, and EMA is able to give us more accurate signals, so that is why some people use EMA. But in my opinion, you should use simple moving averages. My experience says that simple moving average gives you a lot more better signals than EMA and LWMA. So I would highly recommend you to use simple moving average instead of EMA and LWMA. But if you want to experiment, you can go with EMA, you can go with LWMA, or whatever you want. It's up to you, it's your choice. Now let's talk about other methods of calculating moving average. So Wilder method, geometric moving average, and triangular moving average are some of the famous methods which people have used in the past, but these methods are not used right now by technical analysts. So we will discuss that very briefly because it can come in your CMT exam. Wilder method of moving average has been made by Wells Wilder in his book, which he wrote in 1978. And what this moving average does is that it gives the highest amount of weightage to the most recent data. So it's kind of biased towards the most recent data, and it is very much similar to linear weighted moving average. So some people recommend that we should use the Wilder moving average only in average true range, relative strength index, and directional movement indicator, which has been made by Wells Wilder, because in these indicators he has used a Wells Wilder moving average. So we should not use this anywhere else. Only in these indicators we should be using Wilder method moving average. Now there is another moving average, which is geometric moving average. So geometric moving average is used mostly in indexes, and it is plotted not on the basis of price change, it is plotted on the basis of percentage change. So if the Nifty 50 or any other index goes by 1%, then the moving average is going to go up by 1% as per this geometric moving average. So geometric moving average takes percentage change into account, not price change. That is a special feature of geometric moving average, and that's why we should use this in indexes, because indexes are having a long history. Indexes are having a data of 100 years or 150 years, so this data is very old, and percentage change should be used to analyze the real price movement of these indexes. That's why people use geometric moving average in indexes. I hope this thing is clear to you. Now let's talk about triangular moving average. So triangular moving average is simply a moving average of moving average. So this is used in indicators like MACD, where you take a moving average, then you take a moving average of that moving average. So it tries to smooth the data, it tries to double smooth the data to better represent the trend. And this thing can also come in your exam. So I think you should read triangular, geometric, and Wilder method moving average because it can come in your exam. You should know the basics of these moving averages. Now let's talk about variable EMA, which is another kind of exponential moving average. So it has been suggested by Chand and Kroll in 1994, and what it does is that it includes volatility inside this moving average line. So it is EMA with volatility. So EMA plus volatility is variable EMA in short form, and there are other variations as well which people have made in moving averages like Kaufman adaptive moving averages and volume adjusted moving averages. In volume adjusted moving average, volume has also been taken into account apart from price action. So these are some of the types of moving average which I think you should know because it can come in your CMT exam. But from learning point of view, I would say that you should not focus much on every moving average, you should try to master one or two type of moving averages, and rest all you should have some basic understanding about it. So if you know all the basic things about these different kind of moving averages, then it is going to be very much fine from exam point of view as well, and from trading point of view as well. Now let's talk about moving averages strategies. So moving average has been used in four basic ways. People use moving average to determine trend. They use moving average to determine price extreme. They use moving average to determine support and resistance, and for giving specific signals. So let's understand these four uses of moving average one by one. Let's go to trading view, and let me remove this weighted moving average. Let's keep things simple. So here I am going to use only and only simple moving average. So you can see that if I hide this price, if I hide this price, then from this line you can see that the trend is up. We are able to figure out by this simple moving average line that the trend is up, right? So moving average represents a trend and it helps us determine the trend, and that's why we say that moving average help us determine the trend. The second point is that it determines price action. But before coming to the second point, I would like to discuss the third point, which is it helps you to determine support and resistance. How does moving average help you determine support and resistance? Let's look at this thing at trading view. So let me unhide this price, and you can see that the prices are taking support from this moving average a lot more time. You can see that here the prices are taking support from moving average. Here as well, prices has taken support from moving average for a while. Here as well, prices have taken support from moving average. So moving average can act as a support and it can act as a resistance as well. So you can see that in Nifty there is a very strong uptrend. That's why we are able to see only and only support points. But here you can see that this is a resistance point, right, which has been given by moving average, which is this is another resistance point. And we can figure out basically support and resistance point using moving averages. That's what I wanted to say. The second point was that we can determine price action. So let's talk about that point as well. But before that, let me remove all the drawings. So to understand that how moving averages can help you determine price action, let me go to some stocks which I think can better help you understand this price extreme concept. So we will go to Tata Power, because in Tata Power I have seen that how moving average has helped us determine price extreme. So basically, if I talk about moving averages, so moving averages is nothing but an average. So whenever any deviation from average happens, then the prices are very likely to come to the average. You can see that the prices are following this moving average and touching this moving average very oftenly. But from here you can see that the prices have gone up very high and it is very much far from the moving average. So it is kind of making an extreme. If I want to look at the price range, I just want to understand the distance between the moving average and this high point. So you can see that there is 75% difference uh, from this moving average. So you can see that the price has have gone up 75% above from this moving average. So this is kind of very extreme situation, because the prices cannot go up like this. It has to come down back to the averages. So you can see that after the prices went up very high from the price extreme, then it starting coming back to the moving average, and that is what happens with moving average. So I hope this thing is clear to you, because moving average works as a magnet. Whenever prices goes up very much far from the moving average, it acts like a magnet and prices starts coming back to the moving average. And I think this is what is happening in Tata Power stock. This is a very good example of how you can determine price extremes using moving average. One should cover all the long positions at this point because of the price extreme factor which I have told you in moving average. So I hope this thing is clear to you. This concept is not talked very much, but it is an important concept which you should know about moving averages. So this was the third point. Now my fourth point is moving averages are used for giving specific signals. Now what are these specific signals? Let's talk about that. So in this startup hour stocks, you can see that I have used this 50 days moving average, right? But if I use 200 days moving average, apart from this 50 days moving average, then I can create some signals by crossover. So here you can see that the blue line is crossing this red line, and the red line is crossing this blue line. So you can see that this red line is 50 days moving average, and this 50 days moving average is crossing this blue line from below to above, and this is a golden crossover, which is a very bullish signal. So at this point this thing happened, and a buy signal got generated. So this buy signal got generated when the Tata Power stock was around 55 rupees. So at this point, this buy level or buy signal got generated, and you can see that after that what happened in the stock. The stock went up, went up, and now it is standing at 228 rupees. So you can see that how good returns this stock has given, and the power of mechanical trading systems that you can make from the simple crossovers, moving average crossovers. I hope this concept is clear to you, how you can use moving average to generate specific signals. You can use moving averages in other way as well. If I hide this 50-day moving average and keep this 200 days moving average, let me remove these drawings for better understanding. So some people, what they do is that if the prices are below 200 days moving average, then they are going to get short. They will short only if the prices are below from this 200 days moving average. But if the prices are above from this 200 days moving average, then they will start buying. So this is one of the mechanical systems which people use, and that's how they generate some signals using moving average. So people use moving average for different purposes. So these are the four basic ways in which you can use moving averages. I hope this thing is clear to you. I have covered all these points, but I wanted to highlight just one thing. As I told you earlier in the video, I told you that moving averages works best in the trending market, but moving averages can give you substantial drawdown when the market is sideways. So moving averages works best when the market is up or when the market is in a downtrend, but it does not work well in a sideways market. So we cannot easily figure out when the market is going to be sideways or when the market is going to be trending. We need some indicators to identify that, and that's why we use ADX, and which has been developed to determine whether the prices are trending or not. So we will discuss about ADX as well in this video. So before ADX, let's talk about directional movement index, and after understanding directional movement index, we will discuss average directional index, which is ADX. So both the indicators are made by Wells Wilder, and he developed these indicators in his book A New Concept in Technical Trading System, which was published in 1978. And he talked about directional movement index and average directional index, and we will understand this thing one by one. Let's go to TradingView to understand this thing. So right now I am there in TradingView, and you can see that I have put up this directional movement index indicator, and you can see that how complicated this indicator is. So let me simplify this thing a little bit more. So if I go to settings, then you will see that there are three lines which are plotted in this indicator. One line is ADX, and other two lines are part of DMI, which is directional movement index. So we will first talk about what is this plus DI line and what is this minus DI line. So if I just click OK, now you can see that there are two lines. So let me just make this very much big, and you can see that sometimes this blue line goes up, sometimes this orange line goes up. So how does this work? Let's understand this. So you can see that there is plus DI line, there is minus DI line. So plus DI line, which is blue line, whenever it goes up, it signifies that the market is making higher highs and the stock is making higher highs. And whenever minus DI line goes up, it means that the stock or any index is making lower lows. So whenever plus DI is going up, we say that okay, the trend is up. Whenever minus DI line goes up, we say that okay, the trend is down. Now the question is, how do we calculate plus DI and minus DI? The calculation is very simple. What happens is that while we calculate this plus DI line, we look at today's high and previous day high. So if today's high is higher than the previous day high, then we kind of mark this line up, and whenever the stock is making lower low, That means whenever today's low is lower than previous day low, we mark this line up. So this line goes up whenever stock makes lower lows, and plus DI goes up. This blue line goes up whenever stock makes higher highs. I hope this thing is clear to you. And DMI helps us recognize which kind of trend is strong. Whether the market is in uptrend or downtrend, that will be told by DMI to us. So it is a very good indicator. And whenever this DMI lines crosses each other, it generates a signal. So whenever this yellow line is going to cross blue line, we will get a sell signal. And whenever this blue line is going to cross this orange line from blue to above, we will say that okay, it is a buy signal. So that's how we can use DMI to generate signals. Now let's talk about ADX, which is a part of DMI. So let's include this ADX line, and for a while I am just hiding this plus TI and minus TI line. So you can see that I have put up this ADX, and ADX tries to tell us the strength of trend. So there is a thumb rule, and which I'll tell you. Let me find the level of 20 in ADX. So I am drawing this green line at the level of 20. So why I have drawn this line, let me tell you this thing. So ADX has a simple thumb rule. ADX says that if the market is below 20, if the market ADX level is below 20, then we say that the market isn't sideways. And whenever the ADX is above 20, we say that the market is trending. So whenever ADX is above 20, we say that market trends, and whenever ADX is below 20, we say that the market is sideways. I hope this thing is clear to you. So why are we using this ADX, and how ADX is related to DMI? Let me tell you this. So basically ADX is derived from plus TI and minus TI lines. So ADX is an average of plus TI and minus TI lines, and that is why we are using ADX, because it is able to tell us the strength of trend. It is not concerned about direction. So whenever ADX goes up, it says that the market is trending. It does not tell you about the trend direction. If you want to know more about ADX, then I would recommend you to go to stock charts and read about ADX. Here you will find a lot more information about ADX. I'll put the link in the description so that you can read more about it. Here you will get to know about the calculation and the usage, how to use ADX and how to calculate that on Excel, and you will understand a lot more things. So if you practice all these things and if you read on your own, then I would say that your understanding would be much higher. And I hope this ADX is clear to you. Now the question is, why do we use ADX? Now the answer to this question is very simple. We are using moving averages because we want to make profits from the trending market, but we will be able to make profits only when the market is trending. So if the market is kind of going sideways, and if the ADX value is below 20, then it is advisable that you do not use moving average. But if the market is trending, making higher highs, and if the ADX is also above 20, then it is advisable that you use moving averages. How I will use moving averages, let me tell you this thing. So I have put up this 200 days moving average. So there I got a signal. You can see that the price is taking resistance from this moving average. So here I will look at ADX value, and you can see that ADX value is currently standing at 34, which is well above 20 level. So I may initiate a sell trade over there because I know that the ADX is above 20 and the market is likely to trend. And here as well you can see that another signal I got, and this signal I got in 28 January 2020, and you can see that here also the market is above 20. So here also I will be able to take a sell signal. Why? Because the market may trend as per ADX. So that's how I can use ADX to refine my signals, and I will not use moving averages whenever ADX value is below 20. So it helps us sorting out all the false signals, and it helps us to act whenever the right signal comes. So I hope this ADX and DMI concept is clear to you, and I hope I have told you why should we use this ADX along with moving averages. Now let's talk about envelopes, channels and bands. And these envelopes, channels and bands are made because people wanted to refine the moving average a lot more. That's why they made envelopes, channels and band. Now the question is why people made these envelopes and channel, and the answer to this question is very simple. You will find that whenever the market trends or whenever the market is in sideways, you will find that the market makes a lot of movement around moving averages. It oscillates in between moving average, and that's why people made envelopes, channels to figure out when to buy, when to sell. So now let's talk about percentage envelopes, and these are also known as percentage filter. Now let me tell you how does an envelope look like. So if I talk about percentage methods, you can see that this red line is a moving average. It is a moving average of 20 days and it is simple moving average. And above that, you can see that there is a pink line, and below that you can see that there is a pink line. From this red line, if I go 2.5% above, then you will find that this pink line has been made, and minus 2.5% if I go below, then you will find that okay, there is another pink line. So this pink line is acting as a percentage filter, because some people feel that if the prices have gone up from moving average 2.5% above, then it may come back to moving average. So people have used these things to buy stocks whenever the price touches this lower band, and they try to sell whenever the price touches this upper band. So I hope this percentage method is clear to you. So whenever people use this percentage method, they kind of take a fixed percentage, and whenever the prices goes above moving average from a certain percentage, they sell, and whenever price goes below from moving averages a certain percentage, they buy. So some of the channels they have made because they feel that the prices tend to oscillate around these moving averages. But I would say that these percentage methods are not effective because they are not taking volatility into account, and that's why people stopped using these envelopes after a while, because of volatility. They do not account for volatility, and sometimes what happens is that when the volatility is a lot more higher, then these envelopes can give you false signals, and whenever the volatility is low, at that time these envelopes will be able to generate very few signals. So to fix this problem, we included volatility, and that's how we made bands. So this was an example of envelope, and now I will tell you what is band. So bands are nothing but an envelope with volatility. So bands is equal to envelopes plus volatility. I hope this simple definition is clear to you. So one of the most famous band is Bollinger band, which is made by John Bollinger. John Bollinger is a CMT, so you can read about John Bollinger as well as his Bollinger band as well. So in Bollinger band, what happens is that Bollinger band has taken standard deviation to account for volatility. To calculate volatility, they have taken standard deviation in their indicator. And how does it look like? Let me tell you in trading view. So if I go to this indicator, and if I type Bollinger bands, then you will find that we will get this Bollinger band. I am just going to use a very simple Bollinger band. I am not using any variation of that. You can see that that's how Bollinger band looks like. The major thing which I think you should focus is that sometimes it gets shrinked and sometimes it gets wider. So sometimes it contracts, sometimes it expands. That is a feature of Bollinger Bands. So whenever it shrinks, it tells you that okay, the market is kind of very sideways, and whenever it expands, it tells you that the market is having volatility. I hope this thing is clear to you. Now let me tell you more about this Bollinger Band. So you can see that this brown line is a 20 days simple days moving average, and this upper band and lower band is nothing but two standard deviation distance from this moving average. If you don't know what is standard deviation, I would highly recommend you to go to Investopedia and read the concept of standard deviation and read also about empirical study. If you read about empirical study, then I think you will get a lot more understanding about standard deviation. So basically there are three standard deviation: standard deviation 1, standard deviation 2, standard deviation 3. So standard deviation 1 can record 67.5% of the data, whereas standard deviation 2 can record 95% of the data. You can see that all the price action, almost all the price action is within this Bollinger Band, and 95% of the data you will find within this Bollinger Band. Whenever the price breaks this upper band or this lower bands, it signifies a kind of change in trend, a breakout. So whenever the breakout happens from Bollinger Band, we say that okay, the prices have changed its trend, and whenever this upper band or lower band is broken, we say that the trend has changed. And whenever this band is broken, we consider it as a breakout. So one can trade on this breakout if they want, and you can see there that a breakout happened. You can clearly see that here also the breakout happened, and this time the signal was good, so the market went up, and had you shorted over there, then you would have made a lot of profit. Here also the market gave you a breakout, but this time the signal was false. So sometimes the signal may get false, sometimes the signal may get right. As you know that in technical analysis there is no certainty, it's all probability. But you can use these Bollinger Bands with other indicators, and you can use them as a confirmation tool. I hope this thing is clear to you. Now let's talk about the other use of Bollinger Bands. Some people, what they do is that they try to buy at the lower band of this Bollinger Band, and they try to sell whenever the prices touches its upper band. So this is one strategy which some people use, but I would say that one should use this Bollinger Band as a confirmation indicator. So if you are getting some support, and if after that the prices is touching this lower band, then you can initiate a buy position. But you can't initiate buy position only and only on the basis of Bollinger Bands. So it should be used in conjunction with other indicators. Now I have told you two uses of moving average. One is range trading and one is breakout trading. I hope this Bollinger Band concept is clear to you. Now let's talk about Keltner band, which is another band which has been introduced by Keltner. So the Keltner band is different from Bollinger band, and the difference you will find in the moving average itself. So to construct these bands, you will have to calculate the typical price, and that typical price is close plus high plus low divided by 3. And as you know that simple moving average takes only close into account, but this typical price is taking close, high and low, 3 data points into account. This is why this Keltner band is different from our Bollinger band, but it is not used very widely. But you should read about this Keltner band if you want to clear your CMT exam well, because some questions can come from this Keltner band as well. Now let's talk about Stark band. Stark is an acronym for Stoller Average Range Channel, which was invented by Manning Stoller. This Stark bands calculates volatility in a different way. It uses ATR instead of standard deviation, and that is why it differs from Bollinger band. And you can read about Stark band as well. This Stark band can also come in exam. In level 1, only and only basic questions come, so you need not read much about it, but you should at least know the basics. How Stark band is different from Bollinger band, you should at least know this much. Now let's talk about trading strategies using bands and envelopes. I told you two strategies. One strategy is breakout strategy, and the second strategy is range bound strategy. You can use these two strategies while trading through bands, envelopes and channels. Now if I conclude this chapter of moving average, then I would say that the basic way a technical analyst can make profit is by identifying the trend, and moving average is one of the best methods from which you can identify trend, and it can help you identify trend in a very simple way. And the idea of moving average is to give you a summary about normal price history, and moving average helps us recognize trend very much easily. That's why we use that. Thank you for watching this video. If you have any questions, you can comment us in the comment section. You can find us at Instagram, and if you want to ask us any question, then you can mail us as well. You can subscribe to our YouTube channel if you want to watch more videos on CMT. Thank you for watching this video. See you next time.